My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour, and hopefully we'll get some good momentum here on the space, Bill Fleckenstein. Bill, I appreciate you spending time with us here, and I'm going to have this as an edited YouTube video probably in about a week or so. And I have to tell you, Bill, I've always been a big fan of yours. I used to watch you all the time when you were doing the media rounds back in the immediate moments following the great financial crisis as I was building up my own career and my own way of thinking about markets. So this is a real pleasure for me. For those that are not familiar with who you are, your background, just set the stage as far as what you've done, the hedge fund that you ran, and what you've done since you closed it down.
Well, thanks for that warm introduction. I have been managing money since 1982. I started out as a stockbroker at late 79, so I've seen a lot. I've seen inflation firsthand. I saw Volcker operate. There's a lot of people that have only had a couple of decades worth of experience, which is a lot of time they've been in the business, but never really experienced that. And I think have been surprised at how this present round of inflation has all evolved. We can talk more about that. Anyway, I ran a short only fund from about 1995 until I shut it down in early 09. I did so because I thought that QE would make it very difficult to make money on the short side, regardless of the number of opportunities and the bad policies that were being implemented. And so since then, I've pretty much just been running my own money and that of a few friends in a partnership that I've had for quite a long time. So I don't go on Bubble Vision anymore. I gave that up quite a long time ago. I don't see any point. I have my own website where I write a column about the daily action and what I'm doing, and I answer questions. And so that about sums it up in from the 30,000-foot level.
All right, let's talk about the experience on the shorting side for a bit here. What was your approach? How would you go about figuring out what to short, how much to short? Talk about that whole experience and dynamic for a bit.
Okay. Well, it took me a little while to figure out how the best way to approach the problem was. I ran a short only fund, so I didn't have longs. I didn't have longs and shorts. So, you get into these maniacal bursts, and you could lose a lot of money. And in any case, from about 2000 on, I kind of had a set of of rules that don't sound very insightful, but actually worked pretty well. Number one was, what was the Fed doing? Were they making money cheaper and freer, or less available and more expensive? That was a particularly important gradient as to how much exposure I might have and how long I might have it for. Then, of course, I wanted to see the markets or individual securities that were kind of rolling over from a technical standpoint. I don't want to try to catch tops. I'd rather see them roll over and, what I like to used to say, shoot them in the back. And you needed to have, needed to see how companies responded to the news. Obviously, we've gone through a period up until recently where bad news didn't seem to matter. So you need to have bad news matter if you're going to be short. And then, of course, you need to have catalysts, and you have to do research to find out companies that are vulnerable. Unfortunately, doing all of the research is like just about a quarter of the problem. The tactics and the managing the risk are a bigger portion of making money on the short side. At least they were for me when I was running a short only portfolio. I didn't really try to diversify. I basically, a lot of times I would be almost all tech. In 08, of course, I was in quite a number of subprime oriented companies or financials. I normally don't like to short financials because it's all make believe in the first place in terms of the numbers they report. So that's kind of a generic description of how I used to try to go about running a short portfolio with serious exposure. I mean, when I was operating, I was generally at least 80% short, sometimes 150% short. I very rarely was close to flat through all that time.
Okay, there's a lot to hit on there. Okay, so let's first talk about managing risk when you're taking on a short view, because we all know unlimited risk when you're shorting because the upside in theory is unlimited, whereas you can only go down to zero, obviously. Talk about, for the audience, how do you think about managing risk in bear markets and when actively making a directional short bet?
In some ways, you kind of have to approach it a stock at a time, right? In a perfect world, you'd get an entry point in this in a particular security, and let's say let's say you had a company that was about to report. Let's just take a look at Best Buy. They were, well, no, I don't want to do it theoretically like that. So anyway, I would have ideas that I thought might be vulnerable, and I would try to find a spot on the chart where I thought maybe I could find a place where I could put the position on and say, well, I'll risk this much. If it gets through there, in the short run, maybe the idea is not right. A lot of times I would just try to probe to get the position on. Then there would be other rare times. So individually, each time I would try to get the position on in a way that I could manage the risk of the individual position. But every now and then you get into moments in time, kind of like now, where the fat's in the fire and people can see that margins, more expectations for profit margins are too high. These things seem to be deteriorating faster. We found out in the last couple of days based on Snap and Best Buy's reports. And last week we saw Walmart and Target get slaughtered. Big companies that didn't used to be able to move a long ways on a bit of disappointment are now doing that. Of course, that happened on the way up as well. So when you get into a period like now, I would be a little more aggressive about putting positions on. I might be not quite as focused on the risk of the individual name going against me in a way that might make me cover, and be thinking that the overall backdrop is bad. It's feeding on itself. Incremental data points are going to be negative, and I kind of got the wind at my back. That does not happen very often on the short side. I mean, literally in the last 25 years, it's maybe happened. This might be the third time. There was after that was a year and a half bear market, and then '08. But the problem is, like for instance in '08, the government was coming with new programs all the time, and there were these huge surges on the tape. So trying to not get your head torn off in the short covering rallies, or sorry, when there would be proposed legislation that was going to supposedly solve the problems, you'd have these ferocious rallies. So it was really difficult, to try to manage the risk through all of that. Remember they made short selling illegal in '08 for financials. But anyone who tried could be a financial. IBM got itself deemed a financial. So did Winnebago, and of course, what that did at that moment in time was it blew up all the so-called market neutral books, because they all got blown up. They weren't supposed to lose much money, and when we change a rule like that, they lost a lot. So the managing the overall portfolio can be quite tricky. This environment we're in now has been a little more one-sided than I would have guessed on the downside. I thought they might have had a bigger bounce already. But after being such a one-way street for so long, and maybe it's going to be that way on the downside. I really don't know. But for the moment, the Fed can't save the day because they're purportedly trying to fight inflation with midget interest rates.
Yeah, no, that's absolutely right. And again, this is more from my own curiosity. In terms of the way you would construct that short book, how many positions would you try to target? What was your primary approach? So, Carson Block I had on one of these spaces, and his primary thing is try to focus on companies where there it looks like there's some degree of fraud, right? Try to make a real
Yeah,
bet.
I never really liked short frauds. I think if you're running them against a long book, you can do that because you've got some natural protection. Because in periods of wild psychology, the frauds go crazier than the regular stuff. I mean, if I can't if I'm having trouble pinning down a legitimate company that doesn't want to admit their problems because they're maybe in denial, but they're not going to lie. You get a fraud, people don't lie. It's the degree of difficulty factor is so much higher. So I tended not to be involved in those. I mean, I did short a couple of frauds over the years, but I mean for sure, but it wasn't really my cup of tea. And I preferred finding bigger, more liquid companies because it's easier for me to manage my risk. And I would generally have, I don't know, 20 to 30 names. Sometimes I would be very big. I'd have 10% positions. I use options quite a lot to try to control the risk. Oftentimes I would, if I thought a company was vulnerable going into a quarter, I might be short the stock and then I might buy some puts, at a certain place in the chart where I thought, well, people might try to defend it, but it might be bad enough that they'll blow through there. So I might be short Apple's $140. Let's say they're reporting next week. I might be short it and I might have the 130 puts on, and so if it got down there, I could cover the stock and sit with the puts. So I tried to do things where I could scrape out the risk whenever I could, thinking that over time, if I could take my risk down and keep my positions and my exposure the same, I'd be better off. And that wound up working out pretty well for me.
All right, so I think you had mentioned that you were doing a lot of shorting on tech for a good amount of your time. My father actually ran a hedge fund as well, and was one of those guys that made a lot of aggressive bets on shorting against tech from 2000 to 2002. Um, and you said that you avoid financials because it's largely make believe from a shorting perspective, which is interesting to think about. But I'm curious about how you view tech in this cycle here, because you can argue there's a lot of make believe in tech stocks in the hope that these things will be the next big thing. And obviously, I'm referencing ARK there, right?
Yeah.
But talk about some of the similarities of tech from today to when you were kind of in the meat of your shorting experience.
The thing that so two things. The financials, what I mean by that is the flexibility that they're given in terms of the accounting means it's really hard to catch them if you think there's a problem on their books. That's what I meant to say about the accounting. There's so much latitude in what gets called what. If you remember back in the housing crisis, they had level 1, 2, and 3, mark to market schemes, on various different kinds of CMOs and collateralized obligations of all stripes. So anyway, I tended to not like them just because, remember, to win on the short side, you've basically got to get the people that are long to decide that you're right, their idea was incorrect, and they have to sell. So you need some kind of a catalyst. Generally, people like to keep the positions on that they have, generally speaking. So you need some sort of a catalyst to get them to sell. Um, this cycle has probably just as many crazy ideas as did the tail end of the 99 bubble. But I didn't try to get involved in them because we have this other factor at work that it wasn't important back then, and that's the role of the target date index funds that BlackRock and Vanguard run that create that put a bid in the market. And then you had these, cowboys. Now with hindsight, we can see with, some of the Bill Wang and some of the Tiger community apparently were involved in, gunning some of these names. And so there was a whole lot of stuff that really may never make any money that had, tens and hundreds of billions of dollars of market caps. Now, a lot of those have been destroyed. You mentioned the ARK, and that's kind of the one-stop shopping for, egregiously valued tech concepts. The problem with those are until you get in the right environment, they're all about imagination. And so you can't win as a short seller. Like, how am I going to defeat your imagination? I mean, just look at the contortions that some of the Tesla bulls put themselves through, what they've been willing to rationalize. And that's the way it is with a lot of these kind of, cult-like stocks. So in a period where things are kind of crazy, you cannot be short imagination types of names, regardless of how ridiculous the valuation is, because the valuation means nothing. Now that's changed in the last. It kind of started about a year ago. Stocks started, the broad tape started to not go up as much, and then they destroyed the high flying, ARK kind of stuff that you just noted. And now they're getting to some of the bigger names that were real businesses, but are just expensive, like the Apples of the world. Full disclosure, I'm short Apple. So anyway, I kind of got off on a tangent there. I don't know if I answered your
No, no,
question or
no,
not.
no, that was good. And the point about the cult-like stocks is interesting. I've tweeted out many times that when an investment becomes religion, it's time to lose faith, right?
Yeah.
And I see that a lot with the cryptocurrency space, and I see that with Tesla, which is kind of like the Bitcoin of the equity market. I'm curious. Do you think that we're in a weird environment where it's easier for these cults to pop up just because of social media. I mean, I know you had Yahoo message boards back in the day, and you had obviously people talking about some of these stocks that they just massively believed in just because they put a .com after their company name. But it's something different structurally in the way that these stories come up versus history.
No, I'm sure that helps fan the flames and gets people to focus on, maybe more concentrated as a group on the same names. But what really created this insanity was QE 1, 2, 3, and 4, and they never were able to finish QT. So I would argue that the insanity of the monetary policy, coupled with the COVID lockdowns and the right moment in time for younger people to maybe decide to take a fling, then of course the very worst thing that can ever happen to you when you're a novice is to have a bunch of success, because then you think whatever it was you thought worked, and in all likelihood you just got lucky, and that's what happened. And so now a lot of these younger folks that have maybe done really well are starting not to, and they don't really know how investments really work. If I'd have said that a year ago, they'd roll their eyes and say, "Okay, boomer." But the truth of the matter is, I've studied a lot of financial history. I suspect you may have as well. But I don't think a lot of young people have. They don't know that a lot of these various schemes have happened over and over throughout history, and it's only in periods of generally speaking, of irresponsible central bank monetary policy that you have these asset bubbles, and then this time we've got an asset inflation that's also triggered CPI inflation. So we've kind of got the worst of both worlds, thanks to the fools at the Fed. And meanwhile, people try to act like the Fed has all this credibility. And they say, well, the bond market's priced in, 9 rate hikes or whatever. And my rejoinder to that is, oh, really? How about this? The Fed's raised 75 basis points. They haven't really even ended QE. Meanwhile, inflation's raging, and they talk a tough game, but they don't do anything. So I would argue to you that the bond market is tanked because it doesn't like what it sees, and yet the narrative remains, well, the Fed's in charge. This is happening because they want it to. I think before this is over, the people are going to see the Fed for the kind of the half baked financial people that they are, and that's going to create a whole new set of problems. But we're not near that yet.
All right, so that brings with a discussion around the bond vigilante term, which was bandied around quite a bit in the financial media, 2011, 2012, 2013, and then kind of went quiet because everybody and their brother wanted to do nothing but chase yield, right? And I've used this line many times. They wanted yield when there was now. They wanted what yield when there was none. Now they don't want yield when there is none, right? Um, Talk about the whole bond vigilante thesis and why you think that. Let's get deeper in this discussion around why you think that it's not really about the Fed. It's more about the bond market saying to the Fed, we don't believe you and that we have to take care of this ourselves.
Well, I think that first of all, bond vigilantes was a very a term that was used regularly in the very late 70s, early 80s, because the bond market finally got the joke about the Fed. Now, part of that was because the yield curve was inverted for real, and therefore there's no possibility of getting carry. So only people that would sort of be willing to own longer bonds were either obviously serious savers, although maybe they weren't right in their timing, or specs that thought there's a reason for rates could decline. Well, rates couldn't really decline with the curve that inverted and waiting for inflation, for Volcker to decide that he'd broken the back of inflation. So the term vigilante, I thought, was a little bit misapplied back then. But fast forward to now, the Fed got away with QE the first time, I think, in large measure because of the changes in the banking laws and the banks having to repair their balance sheets after the real estate bubble and banking bubble burst. So they thought, hey, we can do this QE. We don't get inflation. And, we did have inflation, but it was small enough relative to what was occurring in financial assets. People weren't too fussed about it. Now we've got inflation for real because they way overstepped their bounds and they overplayed their hand. And then we've got a variety of other factors that have fed into it from from a production and supply demand imbalance standpoint and things like that. But the environment is so dicey now because the balance sheet of the government is so much worse from a debt to GDP standpoint than it was back then. And so I don't think the system could withstand the kind of rate hikes they would need to really break the back of inflation. I mean, we'll have to see how that plays out. Who knows when, if at some moment the equity market's going to buckle in a way that people start to think that inflation will come back under control. I don't really believe the Fed's going to get inflation under control. I believe we've probably seen the highest, year over year readings. But if we go from 8% or 7% or 9% or wherever we are down to 4 or 5, and that's kind of the low end of the range, or 3 to 4, and it just keeps adding up cumulatively, then they don't have control of inflation. I don't really believe that they ever did. I think that events conspired in such a way, between distributed manufacturing around the world and technology. We had a period where moderate inflation, they called it two. If the CPI is a poor measure of inflation, but let's say it was 3 or 4, it didn't bother people because everything else was going up, and there wasn't enough disruption. So now that's all in the rearview mirror because these guys, the Fed, the central banks, believe their own press clippings and thought they could do anything. Meanwhile, as bad as the Fed is, the BOJ and the ECB are even worse. So then the dollar's been able to rally. So a lot of the Fed has gotten away with way more than they probably ought to have been able to, and that led them to, to just continue to pursue bad policies. Well after it was obvious that they needed to do something else.
So I'm glad you mentioned that point, that the idea that there's so much more debt now than before. I keep making this point that if 60/40 is dead, we have a real problem because the system cannot survive if both rates are rising and asset prices are falling, right? Because then you've got higher interest expense to roll over that debt. Oh, and by the way, capital gains taxes drop as asset prices drop. So the revenue side for the government really gets hit too. I want to bring that a little bit to something that's been on my mind for the last year or so, which is the risk of another credit downgrade, like what we saw in 2011 when S&P downgraded U.S. Quality. Now, I know there's a lot of people that will skeptically say they're not going to do that because last time S&P did that, I think they were sued by the U.S. government for something that maybe was somewhat unrelated. But talk about the risk here of sort of a questioning of U.S. credit quality in this kind of environment.
Yeah, I understand the logic for that, and I don't think that's anything that we're going to deal with anytime soon. Because, and I think partly is because Japan and in the UK, I'm sorry, and the ECB are so much worse. I mean, Kuroda's trapped because he's trying to peg rates at 25 basis points for the 10-year. Meanwhile, the yen's been in the tank, and all their imports are going up in price. So it'll be interesting to see how this plays out with the JGBs at the 10-year and the yen. But so down the road, maybe the people are going to look at the U.S. somewhat skeptically. In the past, whenever those things tend to occur, obviously not in 2011, but in the past, before the euro became the euro, there was always a group of central banks to behave responsibly. Mostly in Northern Europe, the Bundesbank, the Northern European countries, Switzerland. Of course, now the Swiss are drunk because they've tied the Swiss franc to the euro. The euro, they have negative interest rates still, given deposit rates, given what's going on. So I mean, I think a lot of things are going to have to happen first before the people start worrying about the credit quality of the United States, because, all these central banks have printing presses. Now, it's hard to use the printing press and people are worried about inflation. So that gets to be a tricky wicket, and that could come up down the road. But I think it's quite a ways. It's a couple of steps down the road, I would guess. Okay, well, so to me, the logical beneficiary of all these policies and the fact that the central banks are ill-equipped mentally and from an understanding and from a backbone standpoint to truly defeat inflation, I've felt that the precious metals would be the best place to be. That hasn't been especially true. I mean, this year gold's done better than the stock market, but I don't think those of us that have been bullish on precious metals feel like we've been rewarded in a way commensurate with the news. I think part of that is because a lot of younger people decided that the Bitcoin was going to be their hedge, and I think Bitcoin is more of a leveraged tech stock and reacts to different things. So, I think the big move in the precious metals that relate around the fact of the incompetence of the governments and central banks of the world is still in front of us. I think we're also going to see, as it turns out, there's when psychology gets wrecked over a lot of these kind of concept stocks, and then people start to look for, well, what's going to matter? What's going to stop them from going down? They realize, well, cash flow, free cash flow, earnings, dividends. And so that's going to be the start of a swing towards value versus this, maniacal search for and paying for anything with a big, total addressable market. So I think that the precious metals and the mining stocks, because they are cheap on a cash flow basis, they're all paying dividends. Some of them have pretty strong earnings, so don't have big multiples. They started to come into a spot where they're going to show real numbers, and then COVID hit, and it uniquely hammered them because mining generally is a pretty body intensive business. And in a lot of these countries, a lot of the mines are in South American countries where the healthcare systems aren't as vigorous as they are here. So I think that in sometime in the next couple to 24 months, there will be a big move in the metals, and there'll be a really big move in these miners. And I think in general, value is going to do much better than growth for quite a long time. That's not to say no growth stocks will go up in price. I just think generically, value stocks. Nobody wanted a value stock because they can't go up at warp speed, and now we're seeing the downside of that concept, kind of mental thought bubble breaking. So I think there'd be a very good place to be. Probably the same can be said for, some parts of the energy business, probably things related, to whether oil or nat gas or all of those things. As everyone now knows, this whole green wave and somewhat overly optimistic viewpoints of people of what they could do with those types of energy generation products or companies was ill-conceived, and we've got a huge. We're way behind where we need to be from a hydrocarbon production standpoint, and you can't turn the switch on and fix that overnight. So that problem's going to be with us for a while. Yes, I am skeptic on Bitcoin. I believe in the whole DeFi concept of finance, whether you want to call it blockchain or however you want to phrase it. But I'm not a big believer in cryptocurrencies as a store of value. I'm not short them. I would never be short them. But it's not where I want to try to make my investment that is predicated on the fact that I think the central banks have lost control a long time ago and will continue to be doing the wrong things. As for the Bitcoin miners, I think probably, see, this is a weird thing. When you talk about something like a crypto or some of those crypto growth kinds of ideas, that's one kind of a crowd that wants to buy that growth, right? But then you try to have value in that area, and it's the wrong, the value guys don't probably believe in crypto in the first place. Not necessarily that's the case. So you kind of get to be not chicken and you're not fish, you're not fowl, right? So I don't have a view on Bitcoin miners. I suspect probably if I was keen on them, if let's say I was keen on Bitcoin miners like you are, I would be a little worried of this environment is so dicey. What happens if some week something happens, the government says something, and we get a big flush in crypto, and then they trip over, the MicroStrategy loan covenants, and you get some kind of a big wash, everything's going to go down in that environment. And that would be something I would be worried. And maybe there's people that are looking at your crypto miners, but really would like to feel better about how that may play out. Now, if that shoe doesn't drop, then maybe they come in and start buying and then they lift. I don't know. It's not my area of expertise, but if I was trying to game the situation, as I might from a short selling standpoint, or even being long something speculative like that, that's how I would. That's what I would worry about. I don't know if that helps or not.
And okay, so Bill, I've heard you talk about, and you kind of alluded to it earlier, sort of the enormous move that we've seen into passive strategies, and I've used this term before, that it's like structural insanity, because you've got
Yes.
this automatic bid, right, that keeps happening,
Yes.
at the turn of the
Yes.
month, and it's all market cap weighted, and let's face it, at the end of the day, it's not the Fed bailing out the stock market; it's the Fed bailing out Vanguard, right? Because that's the
Right.
beneficiary,
Right.
right, from all this, right?
Right.
So let's
Exactly.
talk.
Exactly.
Let's talk about that for a bit, because I think that's something structurally that is very different than the past, and also
Yes.
is conceivably a very big tail risk.
Yeah. And to full disclosure, the man who opened my eyes to this is a fellow named Mike Green, and his handle on Twitter is at Professor Plum 99, I think it is.
Yeah, I had him on.
And
Yep.
yeah, and everybody who doesn't know about this needs to kind of follow Mike and get up to speed, because we have an 800-pound gorilla, and that is the BlackRock and the Vanguard, and what occurs in these target date funds, of which virtually everyone in corporate America is in one. So, as you said, they buy, and it's market weighted indices, and so expensive stocks get more expensive, and so they've really warped the market structure, and they did it. They really came into power at a moment in time when QE was going on, and then we got it exacerbated by all the gambling that went on at home during the lockdowns, with younger folks who decided to get involved for the first time. And so you had this wild frenzy, and all these things were part of it, and this passive bid has really distorted things. Now, how the backside of that actually plays out, we don't know yet. I don't know. And I've asked Mike this, yeah, I don't know what he would say today, because things have changed, but I don't really think you can get into a real trouble there without, serious layoffs in corporate America. And that doesn't seem very likely, even though we're starting to see, some cutbacks in certain areas of technology with hiring. Um, but that's just a slowing of the growth, not really any big layoffs yet. So I don't know how it's going to play out. It is a serious factor, and it'll probably only matter once. And then when it matters, it'll be the only thing that matters. But it's just the fact that it's gone on this long definitely increases the risks, but doesn't necessarily mean that something bad's going to happen, anytime soon.
Yeah, and I wonder if that means that, going back to thinking about shorting opportunities, one should avoid trying to look for stocks that are in some of these passive indices. And I say that because we know from a lot of studies that the moment some stock gets put into an index, the co-movement ends up increasing. The correlation tracks the school of fish, so to speak. The beta gets closer to that of the index, which means it's harder to maybe get some of that idiosyncratic potential. What do you think about that idea? Because I think that's a different way of thinking about how to identify opportunities.
Well, I don't know. It just depends on what you're trying to do with your short portfolio. If you're trying to hedge out longs, and you've got a bunch of longs that are small cap, and you probably want to have a hedge that's got the same sort of personality. You don't want to get a personality mismatch in of what you're long and what you're short. If you're just trying to be a mercenary on the short side, you want to get whatever's going to work in a way you can manage the risk the best. And so, I mean, I don't have any problem being short Apple. I mean, that's probably one of the biggest weightings in all of the uh, um, these various different index funds. Um, so it just depends. I mean, it kind of depends on what you're trying to do. I mean, um, just because they're in the index and they got bid up doesn't mean they can't go down.
Yeah, no. I mean, that's fair. I'm just thinking kind of more as a thought experiment about some of these names, because if you get rid of that automatic bid, maybe you can get closer to what the real, true fundamental value would be.
Yeah, but the automatic bid is across the board of the indexes with the weighting,
Sure.
right? And on any given day, it might be enough to push them up, but it might not be. So, I mean, it really mattered when the tape was working, but now that the tape's not working, I don't know that it's that big of a factor. I mean, and to some degree, that's probably why some of these big mega caps have held up. Maybe that's why Apple was able to hold such a large valuation on such a epic market cap for as long as it did before it finally started to crack.
And where
Years,
are food prices and where are food prices going to be
yeah,
at that point too, right?
yeah. I think probably it's not smaller. I don't know that they're going to be able to get it. You would need a big train wreck for them to start QE and yield curve control, which is probably how they would have to come back with QE. They would call it yield curve control and not pure QE. I don't think there's a meaningful chance of them getting any real reduction. Whether they'd be able to actually turn the spigots on again with inflation running as it is, I guess if the stock market broke hard enough and they said, okay, now inflation's going to come down and we had a few monthly good readings, maybe they could start QE again. I would just say it'll be where it is now to maybe slightly larger. But they're not going to be able to go crazy with it on the upside, and they're not going to really be able to shrink it. I don't know if that's a cop out, but that's kind of how I see it right now. Sure, sure. Yeah, they could. There's all kinds of rationalizations. I mean, let's put it this way. I'm willing to take the over on the size. I just don't know how big it can get because I don't see how they get inflation under control enough to come up with a bullshit story to be able to start QT again. I mean QE again.
Well, but that's the thing, right? Like that's why you can never really get out of this. I know you've said before that the Fed's trapped, and I agree with that because every time they want to try to reduce the balance sheet, it assumes that between now and when they actually do, there isn't a black swan. Well, the problem is, having so much leverage and re-leverage with every single accident, every single crash, that the black swan crashes happen more frequently. So
Right,
you're in this interesting race against time that they've created the ticking time bomb on.
right. So basically, the Fed policies are a failed strategy because they can never be exited. Right? We started with Greenspan in the mid 90s. He made rates too low because we believed in productivity and inflation was going to be under control. And then they led to a bubble. It was kind of kid stuff from a monetary standpoint relative to QE. So we had that bubble. And then when that burst, as the economy was tanking in '01, we had the 9/11 attack and everything got blamed on them instead of the bubble bursting that the Fed had, created. Then the Fed, keeps rates too low too long. We have a real estate bubble. And then the epicenter of holding the leveraged debt that was no good was the banking system, which the Fed was supposed to be regulating as part of the change in Glass-Steagall in 1998. And then we got to QT. So what I would say is we've had a long run, 20 plus years of bad Fed policies and that we've never been able to exit. And each time we've had to come back and redo them, they've been redone in a slightly different fashion. But the net of it is that we cannot leave NERP and ZERP. I mean, they're trying, and we'll see how far they get. And then, what's really, really going to be interesting is what does it take for the Fed to say, okay, we've won for now and we're going to back off in our tightening? What does that and what does the world look like when that happens? And then what does the bond market do when that happens? So all the interesting things that are going to dictate how the next, say, half a decade goes, we won't really have a good look at trying to formulate an opinion until after this tightening cycle is declared kind of over for whatever reason.
What do you
And
think, Bill, about the idea that maybe I mean, I don't think we'd ever see this, but it seems to me like you'd fix a lot of problems if the Fed was simply rules based, right? Instead of having this kind of subjective human decision making element. I mean, it seems to me that that's really the solution. But I want you to talk about, sort of the benefits or risks there.
I'm sorry, the benefit or risks of what? You kind of cut
So
out for a second.
of a rules based Fed. In other words, something that where it's based on something like Taylor rule or some other metric where it's not based on some committee.
I think it would be a good idea because it's not that the Fed was so smart before. It's really they have to take a little page out of what doctors used to, the Hippocratic Oath, first do no harm. And so the advantage of a gold standard was not that gold was magical. It just kind of kept in control the amount of credit you could supply or money you could supply. And therefore things could never get too out of hand. And of course, people would get frustrated and say, well, we can grow faster. We need to stimulate. And now, lo and behold, 50 years after the gold window was closed, we are where we are, and we've been on the seat of the pants standard for quite some time. And it used to be that, and even Greenspan did a little of this before he became such an egomaniac, was that, look, we know that monetary policy works with a long lag time, and we don't really know what that is. And we supplied the system with a whole bunch of stimulus. Now we're going to start taking it back slowly but surely. It's not like they had an exact read on what the stimulus did and what the retraction of the stimulus did. They just knew that from what they'd learned over history was, after we put it in, we need to take it back out, not so we can cut rates when the next problem occurs, which is what they say today, but just because we know adding stimulus historically, it can easily be overdone, and the overdone stimulus is far more dangerous than not enough. That's how you get bubbles. That's how you get bubbles that wind up meeting bad economic policy and lead to the 30s. And that's how we've had all these bubbles. We didn't have any bubbles for a long time in America, and then we've had two or three in the last 25 years. So it's a rules-based standard isn't magic. It just takes it eliminates the abilities for human beings to do something really stupid, like we've just done with QE and QT, and even discussing MMT and all that nonsense.
Yeah, no, completely agree with that. And I think you and I share the same view that nobody can predict the future, right? I always use that line: no amount of intelligence increases the clarity of one's crystal ball. So you can't necessarily blame the Fed for not predicting the future, even though with hindsight it seems kind of obvious, but you can blame them for maybe looking at the wrong data points. I mean, it's beyond me how Powell wasn't simply looking at house prices around his own neighborhood accelerating at the pace that they were accelerating and saying, well, maybe that's a sign that there's way too much liquidity in the system.
It's they made all this stuff up about inflation, about needing 2% inflation, and they deluded themselves into thinking that that the dangers were deflation. And after the '08 bust, I mean, the problem was going to be a depression. A little. I mean, the average person is not going to dislike deflation. Deflation, assets, as the things you need get cheaper. Who's against that? So the central banks have twisted the language and the logic to where they wanted 2% inflation, and they wanted to make up for not having it. It's like having 2% inflation meant you could, you'd found the holy grail. I mean, there's just things that got made up and were made out to be dogma that were just nonsense. I mean, there was never part of the Fed charter that needed 2% inflation. They just said it enough times that everyone said, okay, yeah, that sounds good.
Yeah, you repeat a lie enough times that it ends up being true.
Well, I guess what I would say is that the Fed is going to stay tight, or tight. Like they're going to keep raising rates, and they're going to start QT, and they'll do that until something important breaks. What is that? I don't know. Some level of stock market activity. Some big company. So I don't know what it'll be deemed to be breaking, but something bad will happen, and they'll find a reason to pause or something like that. I don't think they can conquer inflation, but they can break asset markets because they created such a big bubble. I don't know. It's very difficult to forecast or have any confidence in your guess about how this might play out, because in the first place, QE as an idea is only a decade old. They tried to exit last time. They got partway down the path, and then they had to stop. And they're so much more strung out this time. I don't know how far they'll get before they try to declare victory. Obviously, a lot of stock market types thought they wouldn't be able to even stick around this long. It's taken next to nothing to get this big wipeout in the stock market. We had 75 basis points of tightening, and basically just the rundown of QE. We haven't really started QT, so just goes to show you how fraught with risk the market was, that it didn't take much of anything to cause it to kind of cave in.
Right, and we also suggest that maybe the multiplier effect is largely broken, right? Because it's not really in a world of so much liquidity. It turns out there's not much when you need it the most, right? Which I think is what this year it's kind of playing out to look like. I want you, Bill, to spend a few minutes a little bit on trading bear markets. I keep on using this line that bear markets make fools of both bulls and bears,
Yeah.
because right, you have this belief that you're going to have a directional collapse and then suddenly have a 10, 15, 20% rally that rips your face off, and then you switch and then you go short again. And so talk about sort of the difficulty of environments like this, because it's more than just direction, right? It's also about volatility that goes both ways.
Right. That's why I talk about tactics being so important. I mean, and that's what made 2008 so difficult. I mean, the S&P, I think, was down 38%. I think that year I was up like 42 or 43%. And if you'd have told me ahead of time, look, the S&P is going to be down 38, how much are you going to be up? I would have said, I don't know, 60 or 70. But it was so difficult because they kept changing the rules and they come up with these big programs. There were these epic surges, way bigger than the ones we've seen now, and they would come out of nowhere. I mean, this we haven't really seen that, since the market finally started to break here in the last couple of months. It's been kind of straight down. There've been a couple of big bounces, but it's tricky. I mean, it's really tricky in terms of how do you manage the risk of keeping the stuff on through these phases. And it's more of you have to have conviction, because you got to be able to ride it out, but you got to be flexible enough to say, oh, maybe this can go on longer. It's really kind of it's kind of an art. I mean, I mean, I'm not trying to pat myself on the back because I did it. I'm just saying I can't really give you any rules. You kind of have to have a sense of when things maybe they can bounce, and kind of got to move your exposure around a little bit. It's kind of hard to use options when the VIX gets so gets pumped. I'm using the VIX figuratively as a pump up of implied volatility across the board. But so it's just difficult. You have to have real conviction, and you've got to know why you've got things on, and you've got to be willing to take some stuff off on extremes, and you just have to kind of manage your way through it.
But how would people that are not pros at this like you, what should they really be doing? I'm not saying give advice, obviously, but in the sense that the problem with cash, even though obviously it's worked this year, is that after inflation it's really not working, right? The problem with shorting is that, as we know, right, you can get these faceless rallies that break your conviction, right? Nothing breaks conviction more like a drawdown, right? So yeah.
Well, I think if you have an individual short that you're long, let's say you like overstock.com as a company I happen to like, not because of the retail, because another piece of it, and maybe I'm short a little Wayfair against that, right? Because the retail part of the business is not what I'm interested in. I'm interested in their blockchain businesses. But so I'm short a little Wayfair against Overstock. Well, that's kind of, I'm just trying to manage one piece of the risk of that particular idea. But I'm short Apple because I think it's going to go down in price, and so it's not an easy thing to do. And I think, while for the average person, yes, you're going to lose money on your cash. But that's why some of the picks you have to be the kind of things that can do very well. So let's say I got, pick a number, you got 10 or 20% in precious metals and mining stocks. Well, let's say over the course of 2 years, and then you carry a certain amount of cash. Well, over the course of a couple of years, let's say whatever that part of your portfolio goes up 50 or 100%. Well, that 20% makes up for a certain amount of the 8% you lost or 10% you lost over a couple of years in the cash. I mean, the problem is, in inflationary environments, the things that tend to do the best are a little bit less liquid. And if you're going to own less liquid things, you have to have more cash to not get yourself in trouble when you have illiquid investments, right? Not to say mining stocks are liquid, but precious metals and a lot of the things that tend to do well. So it's unavoidable that you'll have some cash that may deteriorate, but it's got a certain amount of optionality that goes with it as to when you deploy it. And maybe the time that you deploy it, you end up making, some big return on it. So I don't think you can get if you get too focused on the fact that, well, gee, if I hold cash, I'm losing, 7 or 8% or 5 or whatever number you think it is. You can't let that make you neurotic. You've just got to say, I've got to hold some cash because I need to manage the risk of something really bad happening so I can take advantage of it. If you don't have any cash, you can't take advantage of it, and you're liable to get hurt when it happens. So you just can't perfectly maximize it. I mean, now, to the extent that you have cash and some precious metals, you're doing better than if you just had plain stocks. So the other thing about bear markets that I think it was Richard Russell used to say is, in the bear markets, whoever loses least wins. So and there's that side of it as well.
Yeah, I used to read the Dow theory letters from Russell back, obviously when he was still alive, quite a bit. All right, so maybe to round out here, and again, everybody that's in this space, make sure you follow Bill here. Obviously, very knowledgeable and kind enough to spend time with us. You had mentioned Volcker. I want to kind of go round trip as far as the conversation here. I'm just curious your thoughts. Who do you think has had it? I don't know, has or had it harder? Volcker in the '80s or Powell here? And the reason I'm saying that is obviously inflation was larger back then, and the pain had to be felt, but leverage was a hell of a lot less, right? So it seems like Powell might be in a worse spot than Volcker ever was. But riff on that for a little bit.
Well, uh, Powell's problem is his own creation. He and Janet and Ben and Al before him, but that's kind of a continuum of federal bank stupidity. Is that those people that I gave you? Volcker, well, the central banks before him hadn't been quite as reckless. They'd kind of rationalized things, but they hadn't said, "Well, we like 2% inflation, and we're going to try QE, and we're going to make up for past underinflating." And we sat through a couple of bubbles, so you can't. So Volcker came into a situation and came up with a rationale. I'm going to regulate the quantity of money and within this band. And that kind of took the human element out of it. I mean, once they made the decision as what the band would be, they could be wrong about that. But it gets back to the point I made earlier. When you're only allowed to do a certain amount, then you got some kind of governor on how crazy things can get. I think people that don't live through it underestimate how difficult it was to do what he did. I mean, there were farmers and I know a lot of home builders. I mean, they hated him, right? Because he jacked rates, and there, a lot of businesses suffered because of what he did. But then he got inflation under control. But people didn't believe it even after it happened in '84, after the economy got strong. Rates backed up to, I think long rates got to, somewhere between 12 and 14 again. I remember exactly what it was. But I can remember in our equity portfolios, we were buying zeros because we could get yields of maturity of 12, 13%, which is a pretty good compounding rate when it's guaranteed. So it took a while for inflation psychology to really die, and just as it's taken a while to get it revved up again. Um, I don't think the present group and recent past members of the central banks, they talk a good game. They say, "Well, we have the tools." It's not about tools; it's about having the backbone. Look, they've had no backbone. They've raised 75 basis points. They're gonna, and we're gonna get tough in the future. We promise. I mean, so I don't think they understand what it would take. I don't think Powell has anywhere near the nerve. Just because he can spell Paul Volcker doesn't mean he could do what have the nerve to do what he did. You know. So now, if Paul Volcker was, it was still alive, and he says, "Okay, I'm taking over for Jerome Powell tomorrow," would he be able to do exactly what he did before? No, but maybe he wouldn't need to because of the precarious nature of things. But when you've been abusing monetary policy for going on 25 years, there is no relatively painless way out. It's going to be pain. It's like any sort of detox program, whether it's drugs or alcohol. Anytime you've been doing things that are bad for you for a long time, whether it's alcohol addiction or drug addiction, it's an addiction. And I would argue we have a monetary addiction. We can't leave these policies, as we're going to see. And each time we've tried to leave since QE, we have been very unsuccessful. It worked for a while, and then they had to stop. And I suspect that'll happen again. So I think trying to compare the eras is rather difficult, as you noted. I don't consider Powell to be anything on the order of what Volcker was. I mean, not even close.
Bill, this was a real pleasure. I'm going to have this again as an edited YouTube video probably the next week or two. Bill, thank you so much, and everybody enjoy the rest of your afternoon and evenings here. Thank you, Bill.
All righty, thanks. Bye-bye.
Cheers.